Okay, so the lecture is now recorded, so we can start the lecture. How are you today? Is everything okay? Are you feeling all right? Are you feeling good? Only 23 people, but the other are going to join us. You are good. Okay, great. Good news. Okay, so let's start. And I'm gonna share my screen. It's better. Okay. And we started with banking regulation yesterday. On Sunday, working on Sunday. Oh, what a shame. So we talked already about that. Okay, this is where we are. Instruments of banking regulation. So by the way, busy Monday. Oh yeah, always. By the way, I sent the my lecture notes yesterday to Lynn with everything I wrote on it. So I think she's going to forward them to you. So you're gonna have all that I wrote, okay? And I'm gonna do that every day. Okay, so yesterday, so I told you that in terms of banking instrument for banking regulation, there is first deposit insurance, capital requirement, the possibility of limiting risk, for instance, by imposing narrow banking, or in other words, by if you forbid universal banking. There is also the question of banking supervision. There are two aspects: agreement, first of all, before starting the bank, and then control during the life of the bank. Internal evaluation of risk. I'm going to talk about that later because this is something which is very important. And public disclosure of information. So we talked already about deposit insurance. So the good aspect of deposit insurance is that it allows solving the problem of bank runs. There is no longer a bank run if you put in place a deposit insurance. But the negative aspect is that it leads to excessive risk-taking behavior by bankers. So this is what we talked about yesterday, right? So that is also something that you have to be aware of. This notion of too big to fail. Well, actually, there are two definitions of too big to fail. So, are you familiar with this expression? Do you know that expression? To fail. No, oh, you are not. Okay. So this is something that you should know. You should be aware of. There are two ways of thinking of this notion of too big to fail. The first way is to say that if banks are large enough, so in terms of size, but also in terms of market power, then they'll be able to absorb negative shock. And so, in other words, if they are big enough, they are not going to fail. So that's the first definition. So this is the first definition of too big to fail. So first definition, if banks are large enough, they are going to resist, let's say, big negative shocks. Okay, so this is the first definition. And it leads regulators to let banks to become big, even if it is not good news for consumers. Because when the market power increases, the impact on the consumer surplus, social surplus, is going to be negative. But there is a second definition, which is to say, if the bank becomes too large, then the regulator is never going to let it go to bankruptcy. Okay, so you see that the two definitions are totally different. Why? Why? Because it would make negative, huge negative externalities. For instance, you can think of Lehman failure. So now there are people thinking that Lehman failure was a mistake. I mean, not to rescue Lehman was a mistake because huge negative externalities. But the implication of this, of course, is that it reinforces the problem of moral hazard to take excessive risk. Okay, it makes this problem of moral hazard even stronger. Okay, and so here you have examples in the US. So this is before this subprime mortgage crisis. Because then there is now the case of Lehman. Now there is Lehman example. But anyway, so in May '84, the Continental Illinois National Bank, one of the 10 biggest American banks, became insolvent. The FDIC, that we know quite well, the Federal Deposit Insurance Deposition Corporation, Federal Deposit Insurance Corporation, guaranteed not only the deposits, but also losses on bonds issued by this bank. So few time after, the controller of the currency, that is the American regulator of national banks, declared in front of the Congress that the FDIC considered that the 11 biggest American banks were too big to let them fail. Too big with 2 O, too big to let them fail. And it was ready to rescue them in all circumstances. So of course, this is related to definition 2. Okay. Is that clear for you? Is that clear for you? Yes or no? Yes, okay. Okay, thank you. So by the way, I've got a question. Is there a lecture scheduled on Thursday? Or not? Or later in the future? Just to be sure about, no. Okay, so the end, okay, of the course is on Wednesday, and later we are going to have a last lecture for instance, for questions or more exercise this. Am I correct? Am I correct on this? Just to know what we will be able to see and the speed of the lecture. Okay, yes, right. I'm going to ask Lynn. Yes, you're right. Okay. Okay, great. So what about capital requirement? We talked a little bit about capital requirements. So the idea is for those of you who are familiar with this notion of economic capital, well, the idea is basically the same. So the goal of regulatory rules is to reduce the problem of excessive risk taking. So in order to do that, there is one strong possibility, which is to once again to separate between commercial activities and investment activities, which was the goal of the Glass-Steagall Act in 1933 through 1999. One other possibility is to impose a minimum capital requirement, because then shareholders have more to lose in case of failure, because they are not going to be repaid. So they should. This is a way to induce them to monitor the chief executive officer behavior in terms of risk taking. So what about the banking supervision, agreement and control? So the objective is to monitor the CEO's behavior of a bank in order to reduce excessive risk taking. So the control of banks, this allows to verify if a bank respects the regulatory rules about, for instance, capital adequacy and risk taking. So in the US, there is this system with a funny name because it is called CAMELS. So the C is for C and A are for capital adequacy. No, sorry, the C is for capital adequacy, A for asset quality, M for management, E is for learning, L for liquidity, and S is sensitivity to market risk, which I'm going to define later. And there is a grade from 1, which is best, to 5, which is worst. So we talked already about this notion of internal evaluation of risk. Well, why is it so important now? Because actually the speed of business is increasing, and now we know that for a bank to go to bankruptcy, it could be very quick, actually. So doing punctual controls, like one control every year, is not enough. Okay, this is not enough. So in order to avoid historical problems like the Bearing failure in 1995, so now, of course, inspection look at the quality of the balance sheet, and inspections also look at income results, income statement, and verify the capital adequacy requirement. But so today, even if a bank has a good financial wealth, the bank can fail quickly. For instance, due to bad results on its trading activity. This was the case, but this is not the only example, but this is a famous example, the example of the Bearing in 1995. So the modification of the bank's activities has also modified the way to implement banking regulation. So now more weights are put on the quality of internal procedures of risk control. Internal procedures of risk control used by banks. Okay, not only to look at the financial wealth, the financial health of a bank at one particular time, but to look at the internal procedures of risk control in order to avoid this kind of unexpected and very sudden failure by a bank. So for instance, in the US, the financial regulatory agencies announced that they were going to evaluate also the internal procedures of risk control, used by the banks. Concerning the internal evaluation of risk, with the CAMELS system, each bank receives a grade which depends on 4 variables. 1, the quality of the monitoring made by the board of directors. 2, the pertinence of politics and limits used for all activities inducing important risk. The quality of risk measurements and of monitoring systems, and for the adequacy of the internal control to fraud and unauthorized activities of employees. So, public disclosure of information. So this is a way to induce market monitoring, which was reduced by the introduction of a deposit insurance. Okay. So the objective is to give a better information to the depositors and to the market by asking and forcing banks to disclose information about the risk they take and about their level of capitalization. Because if, let's say, you take risk, if you take more risk, so in order to absorb risk and to avoid going to bankruptcy, you should increase the level of capital. So capital is a buffer against risk in case of negative shocks. So additional information means that banks have to disclose more than just the balance sheet and the income statement. And this is going to enhance market discipline. So before looking at the Basel agreements, so version 1, 2, and 3, we have to understand a little bit more what banking risks are. So there are a lot of risks that affect the banking activity. But let's say that there are 3 main risks. First, credit risk. So this is a huge risk for banks because it is at the heart of the banking activity. And this is why this risk was the first to be taken into account in the banking regulation. And for instance, this was the risk which was taken into account in the Basel I agreements. So the credit risk is related to the loss of solvency of borrowers, which can, well, actually, the as I told you already, the credit risk is the possibility that borrowers do not repay credit that they receive. Okay, so I repeat, the bank provides a credit to borrower, and there is one risk for the bank not to be repaid. So this is credit risk. And of course, this is at the heart of banking activity. For instance, if there are defaults on important firms, there you have examples, very well-known examples. Then if there is default, well, these firms are not going to repay credit that they obtained before. Okay. So what else? Market risk and risk of liquidity. So market risk is the risk which is associated to variations in prices, exchange rates, interest rates. So most of the time, this is rather associated to trading activities. And it could be very brutal in the sense that variations can be very quick. And this is going to affect the market value of both the asset side of the balance sheet and the liability side of the balance sheet, and also return which are associated, which are taken into account in the income statement. Okay. What is operational risk? So there are two ways of thinking of operational risk. The first possibility is to say that there is a problem with your IT system. So if there is a problem with your IT system, you've got some positions, for instance, in the trading activities, you cannot modify them. So because you cannot modify them, well, there is a huge risk, and you can possibly make money, but you can also possibly lose money, and even a lot of money. So in that case, because you are just unable to adapt, to modify your positions due to a structural problem in your IT system. So if this is the case, this kind of risk is called operational risk. Another example is the case of a rogue trader, like for instance in France, Jérôme Kerviel in the Société Générale. So that guy went to very huge positions which actually were not authorized by the bank. Okay, so the trader did not ask for the possibility to have such huge position. And the problem is that that guy loses a lot of money, okay, due to unauthorized positions. Okay, so this type of problem is also, this type of risk is also known as an operational risk. Okay, so there you have examples like fire at Crédit Lyonnais in Paris. So the trading room went to fire. So it was just impossible to modify positions. And the Crédit Lyonnais lost a lot of money from a trader. So we talked about Société Générale, but there is also the case of the Bahrain or IT incident. So these are the main risks that a bank is facing. But if you look at the weight, the importance of each of the three risks, well, actually, there is one which is much more important than the other, and this is credit risk. So credit risk amounts for around 80% of total risk for banks. And then you have operational risk and market risk. Okay. So, for instance, the capital requirement has to cover these three risks. First of all, the first version of the Basel Agreement was only considering credit risk. Why? Actually, this is the most important risk for banks. Okay. So the Basel Agreement. Okay, so look at this very simplified presentation of balance sheet. So returns, wealth, random wealth is coming from the asset side of, so the asset side generates, so the asset side generates returns for a firm, let's say for a bank. For a bank. The problem is that it is risky returns. But if a firm, as I told you yesterday, if a firm does not repay its debt, interest, for instance, goes to bankruptcy. But if a firm doesn't pay dividends, does not go to bankruptcy. And you see that the higher, for a given size of a balance sheet, so for a given size of assets, the higher the level of debt, the higher the probability not to be able to repay debt. Why? Because of lack of return. So the level of equity is seen as a buffer. Okay, this is a buffer against decrease in returns. Okay. So this is basically what is written here. The solvency of a bank depends on its capacity to reimburse all its liability in case of total liquidation. This depends on the quality of its asset, as well as the amount of its liability. So the equity corresponds to all the resources which age with the risk of a firm, since they don't have to be reimbursed until the liquidation of the firm. So in the case of banks, debts are mostly deposits by depositors, and assets correspond to credits. So the asset side of a bank balance sheet is particularly risky, in particular due to credit risk. However, a bank must potentially be able to reimburse its debt at any time, okay, due to the role of maturity transformation. So remember that depositors have the right to withdraw their deposits at any time. So equity is going to guarantee the financial health of a firm, but in our case, what we are interested in is a bank, against the potential losses that risky asset may imply. So the Basel Committee decided to create what is called solvency ratio. And voilà. So the solvency ratio is to say that equity must at least correspond to 8% of the asset side. So if you look at this balance sheet, so equity 8% of assets. Okay, but it is not exactly what is written over there, because it is risk-weighted assets. Why? Because the regulator actually makes a distinction between risky asset and non-risky asset. Why? Because equity is more expensive than debt. So using equity is more expensive for a bank than just using debt. So when the regulator imposes a level of equity to a bank, well, this is something which is costly. So it would be unfair to impose a bank a minimum level of equity for well-known non-risky asset. So I repeat. So for instance, consider there is 100 non-risky assets. So if you ask a level of 8 of equity, it is costly for the bank for nothing, because this is non-risky asset. So the regulator decided to ask for 8% of equity only for risky asset. So this is the idea of risky weighted asset. So you put a ponderation on the type of assets, So a weight, you put a weight on the type of assets. If I would like to give you just the idea, because it is a little bit more complicated, as we're going to see later, I would say if assets are not risky, the weight is then 0. Okay, because since using equity is costly, you don't want the bank to pay in terms of cost of capital for not risky assets. But if assets are risky, then the weight is equal to 1. And in that case, if you have 100 million, for instance, of risky assets, you are going the bank to have 8 million of equity in its balance sheet. So let me just make you notice that if you want to have more information on banking regulation, and in particular in solvency ratio, capital requirement, yes, you can look at this book, The Prudential Regulation of Bank, by Mathias de Vatripon and Jean Tirole. So this is about banking regulation. So this is a nice book you can look at, okay, if you're interested in. Okay, everything is clear so far? Okay, no worries. I'm gonna ask Lynn, and she's very efficient, so she's going to give me the right answer about whether we're gonna have or not an extra class for questions or exercises. No worries about that. Is that clear for capital requirement? Oh, I see. So what is the definition of risky assets? It's about the risk of return. So let me give you an example. If you consider a credit, because we know that banks or financial intermediaries grant credits to borrower. So what is going to be taken into account is the risk not to be repaid, which is called, once again, credit risk. Okay? But there are classes of borrowers. Okay, so the regulator created, let's say, classes of borrowers. So, for instance, if you consider the state, the government from well-developed country, the probability not to be repaid is almost 0. So this is, let's say, the class of non-risky borrower. But if you lend money to the government of a less developed country, or if you lend money to firms, then the risk not to be repaid increases. Okay, this is one way. This is not the only way, but this is one way to distinguish between borrowers, and therefore to make a distinction between non-risky credits and risky credits. Okay, is that clear? So another distinction you can take into account is whether for a bank is whether or financial intermediary is whether you lend money to a large firm or a small firm. So a priori lending money to a small firm is going to be riskier than lending money to a large company. Okay. Okay, so this is the Basel committee. So you have some so this is the constitution of the Basel Committee on Banking Regulation. So the first agreement was at 1988, Basel I agreements. We talked about agreements even for only one. And the idea was to impose a capital requirement. So in other words, banks from 1988, let's say banks must verify, must satisfy, must fulfill this solvency ratio. That is to say, to have enough capital compared to their risk-weighted assets. It should be higher than 8%. So the first capital requirement, the first solvability ratio was named Cook ratio because actually Mr. Cook was the boss, the director of the Basel Committee. Okay, so the name of the first solvability ratio was the Cook ratio, and now it is McDonough ratio. So this agreement have been adopted in Europe and in the US, let's say in the earlier 19th. But similar rules are now adopted in many other countries all around the world. Okay, so we'll see that in order to compute the solvency ratio, there are several ways to make it. And the way to make it changed over time. So it was not the same way to do it at the beginning in 1988 compared to how it is measured now. Okay. Okay. So these agreements, I mean the Basel I agreements. So recommended the banks to have a level of capital at least equal to 8% of their assets weighted by a risk weight or risk coefficient. And you should notice that off-balance sheet activities were taken into account. Why? Because these activities are risky. So these are risky activities, and this is why the regulator took these activities into account when computing the solvency ratio. So let's say that these weights are called beta. So, and actually you see that they were, because it is no longer the case, but I think this is the easiest way to understand this. So initially there were four categories of assets. So category one, so for instance, it is for cash, because you can have cash here, cash. But of course, this is not risky at all. So it's not necessary to ask the bank to have a certain level of equity in order to resist a risk associated with having cash in the asset side of the balance sheet. So first of all, beta 1, let's say, is equal to 0. No risk, no need to put equity in front of this type of this first type of assets. So this constitutes non-risky asset. Then beta 2 is equal to 0.2. Okay, so if you have 100, you're gonna ask to 8% times 20. Okay, that's the way it is. So this was for loans granted to international organizations and municipalities from the OECD. Okay, so there it's not so risky, so the ponderation is strictly lower than 1. Beta 3, 0.5. For instance, for residential mortgage loans. So in that case, if you have 100, you're going to ask for 50. Okay, and then beta 4 is equal to 1. So in that case, if you have 100, you're going to ask for 8% times 100. Okay, so 100 is for all other loans, in particular loans to non-bank equity holdings and so on and so forth. I mean, equity holdings in the asset side. So we talked already about that. It is if you can invest, so either an investment bank or a universal bank. Yes, here, equity holdings. Okay, so cash in terms of equity, beta 1 equals 0. It depends. It depends. Interbanking loans, it depends. It could be credits, it depends, but most of the time for these two, you have beta 4 equals to 1. Okay. So initially it was 8%. The required capital, the capital requirement, 8% times 0.2 times interbanking loans plus 8% sorry. 8% times 1 times credit plus equity holdings. Okay. But this first solvability ratio was just taking into account so that one. This was just related to credit risk. Then the regulator also took into account the two other sources of risk for a bank, and it started with adding market risk. So in 1996, so there is the introduction of market risk. Excuse me, 1 second, excuse me. Excuse me. So if I want to sum up from to 1996, only credit risk is taken into account. Then from so in 1996, market risk is added, and later, as I'm going to show you, operational risk is also taken into account. Okay. Okay, so this was the and we're gonna compute examples of this. So this was the first way to compute the solvability. No, solvability ratio. The problem with that is that banks were able to go to what is called regulatory arbitrage. That is to say, the risk inside one class, so the risk inside in a particular type of assets is not necessarily homogeneous. So if you take, for instance, let's say class 3 of a set, so if you take class 3 of a set, okay, so let me give you an example. So if you take class 3 of assets. Well, for the you have 100, you're going to find 8% times 0.5 times 100, which is equals to 4. But you see that you can modify actually the composition. For the same amount, you can modify the composition of your asset side. That is to say, you can sell. So if you want to increase, so if the bank wants to increase risk, it is possible by selling rather non-risky assets which belongs to class 3 and replacing these rather non-risky assets by investing in riskier assets which also belong to class 3 assets. So the level of capital requirement will not be modified, but the true risk that the bank takes would be increased. Okay, so this is called regulatory arbitrage. So this is for a given class of assets, the bank can keep assets whose risk is high and eliminate assets whose risk is low. If it is one by one without modifying the total value of assets, it is not going to modify the required level of capital. Okay, so this is one critique of the first version of the Basel Agreement. There are all other critiques like why 8% and not less or not more. There is no diversification effect, no diversification of portfolio which is taken into account, and the maturity of risk is also not taken into account. So for instance, there is no approach by computing duration. Durations are not taken into account in this approach. So the Basel Committee thought a little bit, and since June 2004, so now a long time ago, the Basel agreements were modified, and we went to Basel II. And this is the first time where we now always talk about the 3 pillars of the Basel agreements: Pillar 1, Pillar 2, and Pillar 3. Pillar 1 is about capital adequacy requirements, but now taking into account the 3 risks, the 3 main risks that a bank is facing: credit risk, market risk, and operational risk. So credit risk, it is since 1988. Operational risk, it is since 1996. And credit risk since 1988, market risk since 1996, and operational risk since 2000. and 4. And we are no longer talking about the Cook ratio, but now it is the McDonough ratio. Okay, so the second pillar is about prudential monitoring. And the third pillar is about market discipline through public disclosure of information. So this is why over there I write improving the financial communication. Market discipline through public requirement of information. Something that we talked already about. Public disclosure of information, which is one tool of banking regulation. So what about pillar 2? There are 4 principles. First, banks must have a process to evaluate the adequacy between the level of their capital and the risk they take. We are talking about a process. This is to avoid what we have just talked about, regulatory arbitrage. To avoid regulatory arbitrage. Okay. Second principle, control by the national authorities of the process of evaluation of the risks. And the regulator had the right to ask for an increase of capital. Principle 3, banks must have the minimum required capital. And principle 4, well, we can think of a preventive intervention by the regulator if the level of capital is lower than what is required. I mean, even if the bank is solvable, but if the equity is lower than 8% of risk weighted asset, then this leads to a preventive, it leads to a preventive intervention by the regulator. Okay. Preventive intervention. So there is something that you must understand, that I told you that the idea behind capital requirement is the same as the idea of what is called economic. Okay. The idea is to protect against negative shocks. Okay, but because equity is a buffer against negative shocks. Okay, but what is the difference between a firm which is not a financial intermediary, which is not a bank, or a bank? That for A firm which does not have to satisfy by the Basel agreement, the economic capital, the chosen economic capital can be strictly lower than 8%. Okay. This is, of course, not possible for a bank. Okay. Because also agreements are compulsory. The bank, so let's say a bank, must choose a level of economic capital which is at least equals to 8%. So in other words, than higher than 8% is, of course, possible. Okay. So you can have a bank can have more, but not less than 8%. And this is if you take the car producer. Well, there is no this kind of constraint. Okay, but I think it's quite easy to understand that. So far, do you have questions? Let me know. Is that clear? Okay, great. So I pursue. Okay, so before making a break, I would like to finish with Basel II agreements. So just, it is very easy to understand that now the solvability ratio takes into account the three main risks that a bank is facing. So it's still 8%, but now taking into account credit risk, market risk, and operational risk. And moreover, the way firms compute credit risk is no longer through the use of exogenous weight associated with each class of assets. The credit risk, as we're going to see just now, should be computed more accurately in order to avoid this kind of regulatory arbitrage. Okay. So the difference between Basel I and Basel II is that first, at least for the just talking about the solvability ratio, now the McDonough ratio takes into account credit risk, market risk, operational risk, and moreover, the way credit risk is computed is different from the way it was computed in the Cook ratio. Okay. So for credit risk, it depends on the type of banks. So this first approach is called the standard approach. This is the less elaborated approach, standard basic approach. So there are a few banks which still more or less use this this approach. But the reason is that they are unable to use the other two approaches. In particular, we are considering rather quite small banks. And then there are the two internal based approach. So internal rating based approaches. The first one is called internal rating based foundation, and the second one is internal rating based advanced. So the idea is to find weights which are coming from internal ratings and which really reflect the risk taken in the asset side of the balance sheet. Okay, so I repeat, yes, banks now must have a process to evaluate the adequacy between the level of their capital and the risk they take. So they must have a process to evaluate the risk they take. Okay, so this is these two approaches. For the market risk, there is, for instance, the use of internal models of risk measures, like computation of value at risk, and also of expected shortfall. Okay, so I repeat, computation of value at risk and expected shortfall. And for operational risk, there are three options. So there is one basis indicator approach, so a standard or basic approach, basis indicator approach, which is to put a level of equity which is equals to 12% of the net banking income. There is a little bit more elaborated approach, which more or less corresponds to the standard approach for the credit risk. The weights are given by class of activities. So it leads to the same problem of regulatory arbitrage. And one advanced measurement approach, which is based on an international evaluation. Okay. So now the solvency ratio is such that it takes into account the three types of risk: credit risk, market risk, and operational risk. So it is still the same threshold, 8%, but taking into account, once again, the three main risks that a bank is facing. Okay. So what do you think? Are you satisfied with Basel I and Basel II agreements? Is that clear for you? Okay, yes, good answer. No questions whatsoever? No, really. It's time to ask question. Is there a concern? No, because no. By definition, it's not possible. How to make you understand this? Because it's not an amount of equity which is required by law. Okay, the amount which is required is a ratio. So if you compute differently the risk of your asset, you're going to modify the level of equity, but still respecting, of course, this solvability ratio. That is to say, equity should always be higher or equal to 8% of weighted. But you're right in the sense, well, you're right. Big banks decided to adopt the international, one of the two internal approaches, because they thought they were able to better measure the risk they were taken, but also to decrease their level of equity, still satisfying, of course, the solvability ratio. But they thought that by using the standard approach, actually they would have to, still for 8%, but they would have to have more, an amount of equity bigger than by using an internal one of the two internal approaches. And this is of course, this is if they reduce the level of equity, but still satisfying the solvency ratio. This is good news for them, because the cost of capital, the weighted average cost of capital is going to decrease for them. So the return for them is going to increase. Okay. No other questions? No? So let me know. Are you hungry? Are you hungry? That is what I want to know. Yes, okay. Oh, some of you are hungry and other no. So what to do? Well, let's say that most of you are hungry, which I can understand very well. So let's make 25 minutes, 25 minutes break. Is that enough for you? Yes, it is. Okay, so see you in 20 minutes. See you. Okay, so you hear me correctly? You see me? Okay, great. So this is time to stop the break and to continue about the lecture. So now we're gonna talk about Basel III. So Basel III started, let's say, in 2012, and the implementation, well, it depends on the countries that we are talking about, but let's say it's between 2020 and 2019. And clearly it is a response to the amazingly huge subprime mortgage crisis, financial crisis. Okay, so in some extent, the subprime mortgage crisis showed the weaknesses of the Basel II agreements, and this is why the Basel Committee decided to modify regulatory agreements, and we went from Basel II to Basel III. So different weaknesses are at the origin of the last financial crisis, the subprime mortgage crisis, and these weaknesses highlighted, in fact, the need to reform, to rethink the banking regulation. So here, I'm going to talk about identified weaknesses and their modifications from Basel II to Basel III agreements. So something which is quite bizarre is that actually we observed clearly a lack of capital. Massive need for government subsidies, recapitalizations by governments, huge recapitalization, both in the US and in Europe, in particular in United Kingdom, but not only. So this is surprising. Why? Because we have to remember that actually banks were following the Basel II agreements. So in other words, every bank before the subprime mortgage crisis were respected the solvency ratio, that is the capital requirement. So it's surprising that we observed clearly a problem of lack of capital, and I'm going to explain why later. So the first modification, of course, was to strengthen the capital requirement. Okay, so the second weakness was to say that the Basel II agreements were not taking into account the systemic nature of some banks without focusing on the balance of the financial system as a whole. So Basel III actually introduces macro-prudential measures and not only micro-prudential measures. So don't be afraid. I'm quite used of this. It's going to take 30 seconds and then it's over. So no worries, everything is fine for me. The third weakness was about excessive risk-taking. We already talked about that, especially by banks which were too big to fail. We talked also already about this notion, and here it is definitely definition 2 about too big to fail that we have to take into account. So now in Basel III, there is a leverage ratio per se. Okay, per se. Which is, since it is per se, it is independent of risk, to have an idea of the possibility that the bank goes to bankruptcy due to high leverage. So this is also something which happened during this crisis. That is a liquidity crisis. But mainly, it was probably the first time that this was observed for banks. So you remember, if I show you once again the balance sheet of a bank, yes, here. I show you this. You see that in order to have a balanced balance sheet every day, banks the interbanking in the assets in the liability side here and here. So the liquidity crisis is when the interbanking market is no longer working. Okay, so interbank loans or interbank deposits, during a period of time, it was just impossible. So it was complicated for a firm to have a balance sheet balanced every day. Okay, this is, even if it is compulsory. So this is a huge problem with the crisis, liquidity crisis. For instance, okay, let me show you. Let me tell you a little bit more about that. Yes, there were banks with excess liability, for instance, liabilities, but they preferred not to lend to the banks in order to be able to keep resources for them. You know, because they feared not to be able to obtain enough resources in the future during the period of liquidity crisis. Okay, so interbank financing drives up liquidity crisis. So now there is a control of liquidity risk, a ratio, as we'll see, of liquidity risk. So lack of integration of regulation and supervision, misjudgment of rating agencies, a huge problem with rating agencies. Lack of consideration of excessive risk-taking, asymmetrical remuneration, which induce traders to take excessive risk-taking, lack of transparency. So this is always something which is complicated to put in place. Risk management and supervision and market discipline. If we have time, I hope so, I'm going to talk a little bit about risk management dysfunction tomorrow or after tomorrow. Okay, so what about increasing or strengthening capital requirements? Well, there it is. So here you have Basel II, and here you have Basel III. Let me first talk about the solvency ratio. So basically, you see that you still want a level of equity equals to 8%. So you can say, well, nothing is changed. This is wrong. Why? Because the way the 8% is computed, not in the so the difference between the two is not coming from how to measure risky asset. This is not from this, because in the Basel II agreement, we know that there is already two internal approaches. So that's not the difference is not coming from the asset side of the balance sheet. The difference is coming from what is taken as equity in the liability side of the balance sheet. Okay, so actually, so before Basel III, in Basel I, equity, let's say, was composed by what is called tier 1 plus tier 2 plus tier 3. And for instance, in tier 3, there was included long-term bonds. Long-term, because if it is long-term, it could be interpreted as equity. So this is no longer the case. There is no longer any tier 3. But let's say that tier 1 is true. So only tier 1, and even more than this. Only tier 1 is true equity. Tier 2 is kind of equity. And so the lack of capitalization were coming from this, because it was included, it was taken as equity things which were not really equity. So in order to avoid this, if you compare now, you see that actually tier 2 reduces from 4% to 2%. So through equity increases from 4% to 6%. Okay, and actually even more than this is what you call CET1. So this is minimum common equity ratio. Okay, so actually these are through equities. Through equity. Well, true, real equity. Real equity. So previously Basel II. So this ratio risk-weighted asset was 2%. Now Basel III should be greater than 4.5%. Okay, so this induces an increase in the level of equity. Clearly. Okay. So the original Basel III rule required banks to fund themselves with 4.5% of common equity. Only 2% in Basel II of risk-weighted asset. So once again, the difference between Basel II and Basel III is not coming from the denominator. The denominator is still computed the same way, but there for the this ratio, now it's 4.5% compared to only 2% before. And this must be maintained at all times by the bank. Okay. So we talked about macroprudential measures. So what is the idea of this? So actually, Basel III introduces two additional capital buffers: a mandatory capital conservation buffer and a discretionary counter-cyclical buffer. The mandatory capital conservation buffer is equal to 2.5% of risk-weighted assets. So, this is true capital. So if you make the sum of the two, you obtain 7%. And a discretionary counter-cyclical buffer. So it allows national regulators to require up to an additional 2.5% of capital during period of high credit growth. And the level of this buffer ranges from 0 to 2.5%. So what is the idea? Let's say if the if we are in an economic boom, so the government doesn't want the banks to grant too many credits. Okay, they don't want the machine to explode. Okay, so in that case, in order to slow a little bit down the number or the level of loans which are granted, the government, the regulator, asks for a counter cyclical buffer to be equal to 2.5%. Okay. But in case of economic crisis, recession, in order to help the banking activity and to help banks to provide loans, then the counter cyclical buffer is just 0%. So there is one difference between all the ratios, is that this one is the only one which can change through time. I mean, if you consider the solvability ratio, it is always 8%. Always. Always. Okay. It doesn't matter whether the economy is in a boom or a recession. It doesn't matter. Always 8%. Same for this one. But that one, this is not the case. The level which is required depends on how is the economy. Okay, so this is why we talk about countercyclical buffer. If the economy is in a boom situation, the government wants to reduce the speed because it would become risky. But if the economy is in a recession, in a crisis, the government wants to help the economy. So in that case, it is going to require countercyclical which is equal to 0. Okay. So this is also another difference with
You are currently the only person in this conference.
Of required capital. Now, there are also these two macroeconomic ratios which have to be satisfied. Okay. So macroeconomics prudential ratios. And actually, this is one very important difference between Basel 1.2 and Basel 3. That is to say, if you take into account both So this is something really different from before. Why? Because Basel 1 and 2 agreements were rather microeconomic approaches, were based on microeconomics on a microeconomics approach. In Basel III, there is still a microeconomy approach, but also macroeconomic approach. That is taking the entire banking system as a whole. That is taking into account this systemic risk of the banking system as a whole. Okay, so the macro prudential measure is to take into account the systemic risk of the entire of the banking system as a whole. Okay. Okay. Is that clear for everybody? Let me know if it is not clear, because this is very practical and very important. Let me know if it is not the case. Yes, okay. No questions? The function of the buffer, what do you mean? Resist against negative shocks, as usual. What kind, let me ask you a question. What kind of regulation in place? Yeah. I think there is, so we talked already about deposit insurance and probably solvability ratio. Am I correct? I'm pretty sure that it is. Oh, the entire Basel II. Okay, Basel II, great. Okay. Okay. So the leverage ratio is to have an idea about how the debt, the level of debt of a bank, how the bank is indebted. So Basel III introduced a minimum leverage ratio. This is a non-risk-based leverage ratio. The idea is not to make a distinction between debt which is risky and debt which is not risky. And it is calculated by divided tier 1 capital by the bank's average total consolidated assets. Because you see that this is equivalent to say that debt corresponds to 97 of the bank financing. Okay. But remember that tier 1 capital is quite a narrow approach. So because you could be thinking of 8% required by the solvency ratio. The difference between the two is that first we consider total exposure and not risk-weighted asset. So this is the difference between the two. The two are different. Okay, because in that case, you don't take into account the assets which are not risky. And in the numerator, in the solvency ratio, so solvability ratio, it is tier 1 plus tier 2 over risk-weighted asset. So that one is only tier 1. And moreover, this is not risk-weighted asset. This is asset, only asset. Okay, so comparing the two, this is smaller. So the numerator here, is smaller compared to the solvability ratio, and denominator is bigger. Okay. So this is also something which is entirely new too. This is really entirely new. And this is in reaction to the liquidity crisis. The introduction of two liquidity requirements ratio. So the liquidity coverage ratio, LCR, and net stable funding ratio, NSFR. So let's say there is the first one, which is kind of short-term liquidity requirement, and this is long-term liquidity requirement. Short-term liquidity requirement. Okay, so the horizon of time is the difference between these two ratios, right? So the first one, the liquidity coverage ratio, it is a 1 month ratio that aims to enable a bank to withstand acute liquidity crisis over a period of 1 month. So when we talk about acute liquidity crisis, it is both systemic and bank-specific crisis. But you see, the period of time is 1 month. So its principle is simple. It has that the liquidity reserve of the bank, so cash, liquid securities that the bank holds, must be greater than the liquidity leaks that can be generated by the loss of refinancing possibilities on the market. So this is basically problem in the interbanking market in particular. Okay. So by the loss of refinancing possibilities on the market, by the leakage of deposits, and a series of other factors that may arise during a liquidity crisis. But basically, you see that, well, when we talk about the liquidity leaks, this is for a 1 month period of time. For a 1 month period of time. Okay, so the horizon is there one month. So this ratio is a ratio between 1 month's liquidity reserves over 1 month's liquidity needs. So cash outflows in a period of liquidity needs. And of course, the ratio must be greater than 1. Okay, so 1 month liquidity divided by 1 month needs, liquidity reserves divided by 1 month liquidity needs should be higher than 1. Okay, so it's quite easy to understand. Sorry, excuse me. So what about the second liquidity ratio? Well, mainly the idea is the same, but the horizon of time is not the same. So now the horizon of time is 1 year. Okay. So this time it is a ratio to 1 year that aims to allow a bank to resist during 1 year to a crisis situation specific to the institution. So its principle is the following: the amount of required stable funding has to be lower than the available stable funding over 1 period of time. And of course, if you make the divided by require stable funding should be higher than 1, and this is for 1 year over 1 year of a period of time. Okay. So to conclude about Basel III, it implies first the redefinition of capital funds, because there was a problem of lack of capital during the subprime mortgage crisis. Introduction of macroprudential measures, in particular this one, the counter-cyclical measure, a leverage ratio per se, that is without computing risk-weighted asset, just per se. And the introduction of two liquidity ratios, and for a bank to be able to withstand a liquidity crisis. And so maybe you are wondering about the differences between the two liquidity ratios. Well, actually, if you look at liquidity reserves in that case, so for a period of 1 month, what is taken into account is ultra liquid reserves. Ultra liquid reserves. Like cash, for instance. Here, not only. So this is liquidity, this is stable funding, which is a little bit different from ultra liquid reserves, right? So this is the difference between the two. Well, one difference. Because the horizon, as I told you, is also different, because there it is 1 year, while here it is 1 month. Okay. Yes, sorry. Do you have questions? Okay, thank you for the answer. I see, about Vietnam. About the banking regulation in Vietnam. It's time to ask questions. I think I should increase the speed of the lecture. It's not enough. There is no question. It's too clear. It's not good. If it is too clear, it's not good. It's never good. No, really? No questions whatsoever? Okay, I trust you. Okay, in that case, well, you see, this is the end of the slides. Not all the slides, but for these slides. So we're going to go through exercises, right? And I want to do one particular exercise, which is about not that one, sorry. Not today, not that one today. What I want to do is this one. Okay. Okay, so you've got it. So this exercise is about the previous, this is exercise is based on the saving and loan crisis that happened in the US in the early 80s. Okay, and this is to tell you a little bit more about how it happened. Okay. So, saving and loans crisis. So what we are going to talk about in this example is a question of banking failures and a problem of excessive risk-taking due to moral hazard. So excessive risk-taking coming from due to a moral hazard problem. Okay. So the saving and loans are private institutions whose objective is to make profit. Like banks, well, these are banks, but particular commercial banks. They borrow money from individuals in the form of deposits and lend the money in their turn. Deposits made by individuals are insured by the equivalent to the FDIC, which is called, you see, rather than Federal Deposit Insurance Corporation, it is very specific to the saving and loan. So it is the Federal Saving and Loan Insurance Corporation. Federal Saving and Loan Insurance Corporation. If an SNL cannot pay a deposit, the FSLIC does. The government has provided insurance for bank deposits since the early 30s. We know that. Creation of the FDIC was ready. Insurance was created against bank failures, as well as to eliminate bank failure that arose when a suspicion bank insolvency arose at that time. So we know about it. The depositors then returned for the reason to withdraw their funds, which ended up provoking bankruptcy of banks and even small banks. So this is called bank run. So bank runs. Yes, maybe I can do a little bit more about that. Yeah. Let me check something. No, sorry. Sorry, nothing. Excuse me. Okay. Okay. So the FSLIC funds come from insurance premiums taken from the SNL. Surprisingly, the amount of these premiums is not related to either the risk level of the loan portfolio or the other investments of the saving and loans bank. The crisis of the 80s. Saving and loans were traditionally very limited in how to invest their funds, mainly real estate loans granted locally to individuals with a hypothesis on the property. In the 80s, several saving and loans made riskier investment, including loans to real estate developers and investment in junk bonds. We talked already about that. You know, this is related to the rating of bonds. I think it is lower than double B, even single B, something like that. Okay, the rating of bonds. So risky credit granted to companies. As the real estate market collapsed in several states, borrowers stopped repaying their loans, and the saving and loan became owners of real estate that they could neither sell nor lease. Later, the failures of some companies to pay off their junk bonds led to a collapse in the prices of high-risk loans, leading to a fall in the SNL assets. In addition, a wave of fraud has tinted this sector. This caused an explosive cocktail. More than 500 SNL went to bankruptcy. The FSLIC's reserves proved insufficient to honor the guarantees given to depositors. It was then the American taxpayer who paid the bill through new taxes asked to American people, which amounted to several $billion. Okay, because actually the FSLIC was unable. Sorry, what is this? Was unable. Oh yeah. Was just unable to repay all the depositors. Okay, so that's the story, and in this example, we will try to understand what led the SNL to engage in such risk investment. The first question: do you think that deposit insurance encourage, or on the contrary, did not discourage depositors to be concerned about the investment made by the institution to which they had entrusted? You know, for sure, this is the net aspect of putting in place a deposit of deposit. That is, there is no longer any monitoring activity by depositors. Okay, deposit insurance encourage depositors to stop worrying about investment made by the SNL, since, so this is the answer. By the way, this is the answer. Since in the event of bankruptcy, the FSLIC would reimburse their deposits to depositors. Okay, question 2. If you were protected against the risk of losses if your investment failed, but you could benefit from the profit made in the case of successful investment, would you be tempted to make risky investment? So this is something which is very well known in finance. And this is related to, are you familiar with the what is called a call option? So if you own an option, a call option, you have the right, but you are not obliged, but you have the right to pay at a given price something. Okay, so you have the right, but you are not obliged. So you have the right, but you are not obliged. You are not forced to buy something at a given price. The strike price at a given time or period of time. And something, it is called sous-jacent in French. Sorry, how? Sous-jacent, the underlying. Let me check it. Sorry. Yes, underlying. Precisely, the underlying. Underlying. The underlying. Underlying. Koban. Am I correct? Koban. Koban. Do you understand? In Vietnamese. Oh, sorry. You hear me? You hear me now? Now it's okay. Okay, sorry. You hear me? Yes? Is that good now? Okay, it's good now. Oh, I'm sorry. Yeah, I know. It's the internet. Oh, trust me, I would really prefer to be in Vietnam with you. Really, really. I really appreciate it when I went to Vietnam. I hope that next year I'll be able to go to Vietnam. We'll see. Okay, we'll see. But I'm sorry for this. Even if it's not my fault, I'm sorry. Okay, so what about this notion of call option? So the payment of a call option is the following. So let's say this is the price at the time. So the strike price is called K. K. And there you put the spot price. So K is over there. So you see that in this area, the option is not realized. Okay, because the spot price is lower than what you have to pay in order to buy the underlying. So this is the 45-degree lines. But if the spot price is higher than K, then you are going to realize the option. Okay, so the value at the time at which you can realize or not the option is the max between 0 and spot price, which I'm going to call P minus the strike price. Okay, you can never lose money if you own an option. So the idea is to say that in that case, you are protected against downside risk. So an option gives you the possibility to be protected against downside risk. So protection against downside risk, which is basically the risk that you don't like, because this is a risk of losing money. But you can benefit from upside risk. And that is the risk that you like, because this is the risk of earning money. So an option gives you the possibility to be protected against downside risk, but to benefit from upside risk. So this is why an option actually makes you risk lover and can induce you to excessive risk taking. Okay, are you familiar with this? Do you understand? Okay. But what you have to understand is that for a banker, so let's say, banker is actually protected against downside risk thanks because of its limited liability. You understand this? Because of the limited liability, the banker protects against downside risk. So in other words, if a bank goes to bankruptcy, yeah, I'm going to clarify that. So listen to me. If a bank goes to bankruptcy, the banker, let's say the CEO, is not going to be obliged to reimburse the depositors. Okay, so the FDIC is going to repay depositors, but not the banker. But if profits, so the bank profits are huge, high, let's say high, the banker is going to receive bonuses. Okay. So in other words, the banker is not going to suffer from downside risk. So once again, if a bank goes to bankruptcy, the banker is not obliged to repay depositors. So the banker is protected against downside risk. But if profits are high, the banker is going to receive high bonuses. So you see that limited liability provide insurance against downside risk, but allows the banker to benefit from upside risk. So typically, this is equivalent. So limited liability for the banker is equivalent to being endowed with a call option. But what is important is that it induces the banker to take excessive risk taking, and it's very easy to understand why. Because on the one hand, the banker is protected against downside risk, but on the other hand, the banker can benefit from upside risk. Okay. So this is a banker to take excessive risk taking. There is an asymmetry between not suffering when things go badly, but from things when it goes in a good direction. Okay, is that clear? You hear me? Is that correct? You hear me correctly? Sorry, connection is not good. Okay. I hope that it is going to be better tomorrow. You hear me? You hear me correctly? Okay. So if you hear me, just to finish the question, because that now we know the effect of limited liability on the behavior of a banker. So now the answer is quite easy. it is question 2. Question 2. So if you were protected against the risk of losses, which is typically the case due to limited liability, but you could benefit from the profit made in case of successful investment, would you be tempted to make risky investment? Yes, of course, the answer is definitely yes. Okay. So in this case, whatever my risk aversion to my in this case, whatever my aversion to risk, I would choose the risky investment. Since I am protected against the risk of loss, so I am protected against what is called downside risk, but I can take advantage of favorable situations. That is, I benefit from the upside risk. Okay, risk of an increase, but I'm protected against the risk of a decrease. Okay, so that's the end for today. Questions? It's time. Why is there no questions? Is that so clear? You hear me? Yes, you do. You do. You do hear me. I'm pretty sure. You want to stop? You want to stop? You really want to stop? Okay. Is that what you want? You understand this? Is that clear? Okay. Okay. So we have to stop and enjoy your evening. I hope that okay. I hope that it is clear so far, and see you tomorrow. Okay. Good evening. See you tomorrow. Bye bye. Bye bye. See you tomorrow.
You are currently the only person in this conference.